Dollar. Yes, sir. Here's the process, my brother. I'm gonna give you the example using GBP USD. It's a trade we took not too long ago. Ignore the most two recent candles there. We are focusing on the week of, or the first week of September, rather. Our reference points, yeah, this is how the process would work. Like, this is a new week. This is yet to print. These don't exist. The previous week, you mark out the previous weekly low and the previous weekly high. Once that's done, you go down to the daily time frame. On the daily time frame, what you're just gonna wait for is for price to either hit the high or to either hit the low of the previous week. If it hits the previous week's low, you go down to a lower time frame. There's an entry pattern we look for only after it strikes the previous weekly low. If it strikes the previous weekly high, we go to a lower time frame, we look for that same entry pattern, and then that's it, bro. You can either look at it using the previous weekly high or previous weekly low. You can even look at it using the previous daily high or previous daily low. Look at these two candles here. You see that bearish daily candle? You see this candle here? It strikes the previous day's low. I bet you if you scroll down to that price action between those 2 days and look for the pattern I'm about to show you, you'll see something. But you can see it then begin to move its way back up. Same concept with this. Previous weekly high, previous weekly low, previous daily high, previous daily low, previous session high, previous session low. Those are the three levels that I look for. So I mark out those levels that I'm looking at. I stick to one. I'll either look at a previous weekly or a previous daily or a previous session. Most of the time, I know my previous weekly ones. Those are my very A plus setup trades. The previous daily ones, yeah, once in a while, but previous weekly high ones, these ones I pay special attention to, and these are the ones I'm gonna show you. The process is exactly the same. The only difference is just the levels that you use, right? So now you can see in this example, now that we're looking at that first week of September, just ignore all of this movement there. It first hit the previous weekly high and then it hit the previous weekly low. Zooming into an hourly chart, you can see here it hit it and then suddenly it started to shoot downwards, right? Here you can see this one I'm not gonna really speak on it because this pattern doesn't look as clean. You can still see the pattern, but it's not as clean as what I'd like it to be. This one is clean F, so that's the one I'm gonna speak on. But then just going back, you can see previous weekly highs and lows, right? We hit the previous week's high, then we reverse down, hit the previous weekly low, and then reverse back up. Now, with regards to the pattern we're looking for, it's this. This is from that ICT 2022 mentorship I swung you, right? So in this case, the bullish example, you see look at the page. You see that black line that says higher time frame point of interest. In this example that I'm showing you, the higher time frame point of interest is the previous weekly low. That higher time frame point of interest could either be a previous daily low or it could be a previous session low in a bullish example. In this bullish example that I'm showing you, that black line, which is our higher time frame point of interest, that black line, let me just move this here so that it's clear. This black line here, after price has hit it, in the example I'm showing you, is the previous weekly low. So only after price hits your higher time frame point of interest, that's when you go to a lower time frame and you then look for this pattern to show. So that's the first thing, higher time frame point of interest, or it could be a fair value gap. You could interchange it. The logic is the same, but then that's the first thing. Price needs to hit that higher time frame point of interest. With regards to the entry pattern itself, the mechanics you'll have via the mentorship, but this is just the summary. You just look for the entry pattern after price hits your higher time frame point of interest, and that's it. For me, It was the previous weekly low. Once price hit it, the pattern formed, hit the low, took out the low again, pushed up, break of structure, opened a fair value gap, came back into the fair value gap, and then pushed up. The pattern isn't as clean as here, example wise. This makes it look very clean, but like logic and everything is exactly the same. And that's it, bro. You mark out your higher time frame point of interest, wait for price to hit it. After price has hit your higher time frame point of interest, look for that pattern. Once the pattern forms, you then have your entry, and that's it. How you manage the risk and target those things, yeah, I don't know how you do it. I'm not gonna comment on that. But then, in regards to process, this is it, bro. Nothing crazy, nothing too complicated. Analysis doesn't even take 2 hours. I just start the week on Sunday, mark out previous weekly high lows or previous daily high lows, wait for price to hit the levels, wait for price to hit the patterns on my entry time frames, and then we done.